Here's everything that you need to know about a DSCR loan in 2025. All right, for those of you who don't know me, my name is Aaron Page. I've been a mortgage broker for 14 years, operating mainly out of the Pacific Northwest, but I have the ability to cover the whole United States with the exception of New York. Today, I want to talk to you about DSCR loans. This is one of the best options for real estate investors who don't want to have to go through the hassle of traditional qualifications when it comes to buying an investment property. Let's quickly talk about what a DSCR loan is before we dive into the specifics. So, DSCR stands for Debt Service Coverage Ratio. This is how the lender essentially measures will the property offset itself or pay for itself by offsetting the mortgage with the rents that the property brings in. These loans were originally created for commercial real estate. That's why you probably haven't heard of them, but lately they've been getting more and more popular and are now available on residential properties. On the commercial side, these were a go to for investors for certain reasons, and the top three are right here. Number one is you don't need to provide any tax returns for this loan. It's a commercial use business purpose loan, so no personal or business tax returns are required for this loan program. The second piece, there's no personal income verification. So your job and the amount of money you make in a month does not matter. This loan is simply looking at does the property offset itself by bringing in enough rents to offset the payment. And again, this kind of ties into number three, but the approval of the loan is simply 100% based on the cash flow of the property itself. Like they always say, cash is king. If the cash is there and the property cash flows, it's a great option for a DSCR loan. The main people that this loan is going to benefit are going to be investors who don't qualify traditionally or that would potentially qualify traditionally, but they write off a lot on their taxes and they don't want to have to jump around and do all the explanations and get CPA letters. They want a very clear, straightforward path to lending to finance their investment properties. This is also really big for people who are self-employed in general and they write off a lot on their taxes and maybe they don't show a lot of money when it comes to their actual bottom line due to write-offs on their taxes. This is a great program because as I stated in the beginning, there are no tax returns required on this program and there's no income verification either. Let's hop into some of the guidelines on DSCR so you can start to see the parameters that you can operate in for this loan. First, to start off, you can do a loan amount all the way up to $3 million. So, as you can imagine, this is a pretty healthy loan amount based on the property that you're looking for. But again, remember, the property has to cash flow. If you have a $3 million loan amount, let's say you have a $20,000 a month payment, that investment property has to bring in at least $20,000 a month or whatever that number is on a $3 million loan. Now, for property types, you can use this for single families all the way up to 29 units. When you get above 29 units, I honestly don't even know how they settled on that number, but most of my investors that I work with, 29 is the max that they will allow on the lending side. So you can go from a single family home all the way up to a small to medium sized apartment complex using this type of financing. You also can use this for purchases, of course, but also for refinances if you just want to do a rate and term. Maybe you bought a property using hard money and that's a double-digit interest rate. You can just do a rate and term refinance, get a better rate, and pay off the current private money and roll it into a DSCR loan. And of course, you can also do a cash out refinance as well. So this is a no documentation, no tax return, no income verification way that you can access your capital to roll that into another investment or just have a nice little nest egg sitting in the bank. One of the main pieces that investors also like on this is that if you were to do a loan with Fannie Mae or Freddie Mac, like a conventional loan, there's a limit to the number of properties you can have financed, and typically that's 10 units. If you have 10 or more items financed, you wouldn't be eligible for a conventional loan anymore. With a DSCR loan, since it's business purpose and technically a commercial loan, there is no limitations to how many things you can have financed as long as you're paying your bills. Let's talk about loan terms and down payments associated with those terms. The minimum down on these DSCR loans is 15%. So you actually can have an 85% loan to value. However, the sweet spot is 20%. That's where you're going to get the best break on interest rate. You can do it with 15% down, but you're going to feel it when you look at your interest rate. To do 15% down as well, the property has to have a strong cash flow. It cannot be below a 1-to-1 ratio. And is what I mean by that is if you're buying a home and the monthly mortgage payment is going to be $3,000, but that property, when we do the appraisal, only rents for $2,000, it is not going to work with 15% down. You can do that, but you will be required to put more money down in that scenario. As I already alluded to, at 80% loan to value or 20% down, this is the standard for this loan. This is the sweet spot for rates to make guidelines easiest to allow for lesser ratios to offset on a 1-to-1 if your property is not renting for the full mortgage payment. You can do this at 20% down if your rents were a little bit under market. And finally, to round this out, the absolute best pricing you're going to get is 25% down or more. I don't need to elaborate much more on that. As you would imagine, the more you put down, 25% above, put 50% down, you're going to get the same rate, but you're going to get the best of the best. For loan terms, you can actually do a 30-year fixed, you can do a 40-year fixed, and you also can do a 30 or 40-year interest only if you really want to maximize cash flow. There are some reserve requirements for this loan, so let's touch on those really quick. And reserves are simply money that you have on hand in case of an emergency or something happens. You need to show that you have X amount of dollars in the bank with the ability to make the payment. And on purchases, that's for 3 months. So if your monthly mortgage payment on your DSCR, your proposed payment, is $3,000, you will need to be able to show that you have in a 401k, in an investment account, something, or cash on hand, being in a checking account, not literal cash, $9,000 in that case, which would be 3 times or 3 months reserves of the proposed housing payment. Here's one of the cool things if you're doing a cash out refinance in regard to reserves. If you're taking cash out of a property, your cash out that you're actually taking can be used as reserves. So you don't need to show additional money on hand if you are taking out cash on a refinance that would qualify. Credit score requirements are a minimum of a 620. The higher the better on scenarios like this, but if you have a 620, you would be eligible for a DSCR loan. However, the higher your score, the better your rate, and at a 620 credit score, the rate will be reflective and you will feel it. In addition to that, the lower your credit score, the lower your loan to value cap is going to be. If you want to buy something with a 620 credit score using a DSCR loan where you're not showing any income, you're most likely going to be capped around the 60% loan to value mark, which would require you to put at least 40% down to fit the terms and the guideline of the program. DSCR loans are great for short-term rentals, Airbnb, VRBO, as long as they cash flow, and there is a way to prove it as well. We can do a rent schedule on the appraisal, set it up to say it's going to be a short-term rental, get the proposed rents or the estimated rents that will come from that, and use those rents to offset the payment. Another fun property type is non-warrantable condos. These don't come up all the time, but sometimes you will find a condo that's considered non-warrantable, meaning there's an issue with the condo, maybe with the HOA, maybe it's underinsured, something along those lines, or a condo tell, if you will, that has a bunch of retail space down below, or is just simply being used as straight Airbnbs. Those are hard to finance traditionally, but they are available on a DSCR loan. The last piece I'm going to touch on with this is first-time investors. Even if you don't own a home right now and you rent, but you want to get into the real estate market by investing in property, you are eligible. This just recently changed. You used to not be eligible if you were not already a homeowner or had been a homeowner in the last 3 years. But as of now, first-time investors, even if you're renting an apartment or renting a home somewhere, can buy a home using a DSCR loan as well. My final thoughts that I'll leave you with here are, if you are a property investor and you have not heard of a DSCR loan, I would welcome the opportunity to talk to you and give you an overview of what this looks like to see long term if this will free up some cash flow for you, allow you to keep more cash on hand, and utilize a resource that you may not be aware of. It's a lot cheaper than private money, and we still close these loans in about 3 weeks. Let's get connected and see if a DSCR loan in 2025 is the best option for you and your portfolio. I want to thank you guys for watching. Keep your eye out for the next video. We're going to be adding more on DSCR loans with further breakdowns and more analysis on how these can help your portfolio grow. Thanks so much.